The national debt danger zone. Is government debt about to drown the U.S. economy? Has it already happened and passed the point of no return? Today, we're examining a massive problem. The U.S. is piling on debt way faster than the economy is growing. We'll chart this explosive gap over different time periods, look at how wage growth compares, how the size of government affects debt and growth, see how interest rates are affected, and unpack why debt isn't delivering the growth that it used to and what that indicates about the direction and the future of the U.S. economy. So, to start here, I think it's important to establish a concept, which is debt is not always a bad thing. There is productive debt. If you are making $50,000 a year as a warehouse worker, and you go into $150,000 of debt to go become a doctor, well, that debt, even though at the time it might have felt like a lot, it might seemed like a lot, it's three times your total annual income. Well, immediately, after 4 years, you're able to start generating $300,000 of income every single year for the rest of your life or until you retire. So the overall level of debt does not matter nearly as much as debt in relation to other metrics, which is what we'll look at here. I do want to show here is the absolute level of debt. So everyone hopefully knows the US is about 36, $37 trillion in debt. That is a huge number. I'm not trying to say that that is not a mind-boggling number, because it is. And I think this graphic illustrates just how large that number really is. But the point here is that it's not really the most important number, or even really important at all. It's fun to try to think about and visualize 36, 37 trillion in debt. But in terms of, is America in a debt crisis? Is a debt crisis about to occur? What are the effects? All those sorts of things. It's not really that instructive. So Reinhardt and Rogoff are this paper. Many people may have heard of it. This was written by Reinhardt and Rogoff in 2009, and it talks about debt to GDP. And it basically, the conclusion here, I will link to this if people want to buy it or find it somewhere. The conclusion here was that as your debt load increases, your growth, or your GDP, or going back to the prior analogy we were just using, your income. I understand it's not a perfect analogy, but just it's the best I can think of. Your GDP, your income, the more debt you go into, the lower your income is, the lower your GDP is. So as your debt to GDP surpasses 90%, which is the level that they chose to pick, your growth rate stalls out. And remember, that growth, that GDP, is the economic activity off of which your debt can be serviced. You can make your interest payments and potentially pay off the debt. The GDP is the overall economic output of an economy. This is what the government can tax to pay off the debt or to service the debt. And the fundamental conclusion of this paper was that as that debt to GDP increases, you get less and less return for each dollar of debt. Well, there were issues with the methodology and some of the data, so they did a revision here, or an update in 2012, and the conclusion was the same thing, which is, in general, that there is this debt overhang wherein, as an economy becomes more and more indebted relative to their GDP, as that debt to GDP increases, the growth rate will stall out and slow down. So the more debt you go into, the less growth you actually have. Now, this is more pronounced in emerging markets than it is developed markets. The U.S. is clearly a developed market. I would also say I did a video on Japan, and they're kind of, I think, a great case study. Now, they're slightly different from the U.S. in terms of military expenditures and defense, but also in terms of current account and net international investment position and kind of capital flows and the structure of their economy. Their demographics are different. But regardless, Japan is kind of a good case study of what can happen. And they mentioned this long overhang where, out of 26 episodes where they examined a country with debt to GDP above 90%, out of 26 of those, this decrease in growth, 20 of them lasted more than a decade. Japan called it the lost decades. And I think that, that I will link to that Japan video that I looked at the debt and the Japanese economy. I will link to that at the end of this. But the conclusion remains the same, which is the more government debt increases relative to GDP, the more that it crowds out private investment, the more that debt crowds out real, productive, healthy, positive return sort of investment. Not only that, but as your debt load increases, your interest cost goes up. Now, they found an inflationary link with emerging markets who have debt denominated in other currencies. The US government can obviously print the US dollar. So here, we're going to go through a couple periods of time just to hopefully illustrate this. Remember, what we're going to look at is basically debt to GDP. We're just kind of visualizing it in a different way. We're looking at the percent change since the start of the chart of debt and the percent change since the start of the chart in GDP. Remember, GDP is the overall economic activity off of which the debt can be serviced and potentially paid back. Well, post 1950, post World War II, the debt has grown 1.5 times as fast as GDP. Post Great Society, this was really the last period of kind of populism, and this was when the size of government really expanded and the size of government spending really expanded. Debt has grown 2.7 times as fast. So even from 1950 into the mid 60s, we can see that the gap is widening between debt and GDP. We went from debt growing 1.5 times as fast to now, from post 1965, debt has grown 2.7 times as fast as GDP. While post Nixon shock, post the end of the gold standard or gold convertibility in 1971, debt has grown 3.7 times as fast as GDP. You can see that this gap is widening. The debt is accelerating at an ever more rapid rate. Meanwhile, the growth is not coming anywhere close to catching up to it. So I think there's this other really important period of time, which is the early 80s. This is when we started to run a trade deficit. So for about a century, or as long as the data I can review for the US, we ran balanced trade or relatively balanced trade. What started to happen in the early 80s was globalization really kind of started to take off, and the US started to run a trade deficit, a current account deficit. And we can see that here. We can go back as far as the data goes, and we ran relatively balanced trade. Well, as soon as kind of 1982, 83 came around, we started to run this large trade deficit. Now, at the peak here in 1987, this was a $39 billion trade deficit. It doesn't sound like a lot when we're talking about a $450 billion per quarter current account deficit now, but at the time, remember, inflation and currency debasement. At the time, $40 billion was a lot. And we can always look at this current account relative to GDP, but the point here is the direction. And so one of the ways that the current account deficit or trade deficit gets balanced is by capital account surplus. That is the other side of a trade deficit, is a capital account surplus. They must balance out. Those two, if you run a trade deficit, you must run a capital account surplus. And this means that foreigners are pouring more money into your financial assets than you are pouring into their financial assets. Foreigners are buying more of your financial assets than you're buying of theirs. This is that net international investment position concept or way to visualize the difference between those two numbers. What we can see is that the trade deficit and the current account deficit really kind of something changed here in the 80s when this started to just go parabolic to the upside. But this was great for financial assets like stocks, treasuries, corporate bonds, real estate, all sorts of things. Right now we're getting a $450 billion per quarter structural bid into financial assets. So if you're wealthy, in the top 1%, you own a ton of financial assets. This current account deficit has been great for you. So there is always another side to it. But again, remember, one of the ways that you finance a current account deficit or a trade deficit is by issuing debt and having foreigners buy it. So you can think we offshored our factories to other countries like China, and they bought our stuff, our financial assets. Well, one of the biggest financial assets for them to purchase, and it goes into the concept of the dollar as reserve currency, is our debt. Remember, when people talk about the dollar as reserve currency, these foreign countries are not, stacking $100 Benjamins, $100 bills, in a safe. They're stacking treasuries. A treasury is just a dollar with an interest rate and a maturity. Well, debt, they need debt to buy, right? And so when we're looking at the trade deficit and what came first, the chicken or the egg, they need financial assets to buy. So this is why when you look at the current account deficit, the trade deficit, and our fiscal deficit, the correlation is so tight. Is because these foreigners. Remember, we established the way you balance a trade deficit or current account deficit is by capital account surplus, meaning foreigners are buying more of your financial assets than you're buying of theirs. Well, one of the ones that everyone wants is U.S. Treasuries, and so this is Triffin's dilemma, which he warned us in the early '60s about, which is that by being the reserve currency issuer of the world, you must run an ever larger trade deficit, an ever larger current account deficit, and that has all sorts of negative effects, especially for people in the Rust Belt. They went from being able to afford a decent middle class life with a good paying job at the local factory, the local mill, and now they're unemployed and probably have opioid issues, right? So this hit certain sectors. This kind of reorientation of the American economy hit certain sectors really, really hard, like in the Rust Belt. This has led to societal issues. This has led to political issues, and kind of the current state that we find ourselves in. But when we're talking about debt, it's really important to remember this trade deficit, remember this current account deficit, because this arguably is interlinked with the debt picture. And we can see the direction that it is moving in. So post-China shock, which was when China was admitted into the World Trade Organization in 2001, we can see that debt has grown 2.9x as fast as GDP. So 3 times as fast as GDP. The other way to put this, the other way to think about this, rather than debt has grown 2.9x faster than GDP, is that GDP, or the economy, has, for every dollar of debt that we have gone into post-2001, we have only gotten about 35 cents return. So we go into $1 of debt and we get 35 cents of return. This is the kind of the other way to think about it, as just flipping it around. But debt has grown 3 times as fast as our economy since 2001. Put another way, for every dollar of debt that we've gone into post-2001, China shock and also global war on terror, and kind of all that that goes along with that, we've only gotten 35 cents of return for each new dollar of debt that we issue. So post-2008, debt again has grown 2.8x as fast as GDP. Again, put another way, post-2008, every dollar of debt that we've gone into as a country, we've only gotten about 35 cents a return. Post-2019, this was the repo rate crisis. We did a video on that if you're interested. Since 2019, so the past 5 or 6 years, debt has grown 1.8 times as fast as GDP, and interest has grown 3.8 times as fast as GDP. I threw on interest here because this is when interest started to suddenly matter suddenly again. And we can see, the dramatic increase in the interest expense relative to our economy, which has only grown 37%. GDP has grown 37%. Well, interest expense has grown 135%. And this isn't even the most updated data. This is lagged. It's even worse than this, actually. This data from September of 2024, our interest expense is actually even higher now. So it's even worse than this. Interest has probably grown 4.1, 4.2 times as fast as our overall economy. So not only is the debt side growing twice as fast as our economy, we're getting 50 cents of return. For every dollar of debt that we've gone into post-2019, we're only getting 50 cents back in terms of economic output. In terms of return, we're only getting 50 cents back for every dollar of debt we go into. Not only that, but the cost of that debt has skyrocketed and increased 4 times as fast as GDP. Not only that, as if that wasn't bad enough, but not only that, there's this other concept. So just as we talked about debt to GDP, crowding out private productive investment, higher interest rates, right, leading to increased borrowing costs and creating a self-perpetuating cycle. All of those dynamics that we just talked about. Well, there's even another side of it, which is as the government grows larger and larger and larger in terms of what share of the total economy do they make up, that also has a negative effect on GDP. So just as increasing debt levels in the form of debt to GDP, just as increasing debt levels have a negative drag, the higher you go debt to GDP wise, the lower your growth rate. Not only that, but the higher your government spending as a share of GDP goes, the lower your growth rate. And so, here we can see the share that the U.S. government spending has made up relative to GDP, and this includes state and local. These numbers here, are percentage increase. Is one way to think of it. Since 1900, we went from the government being about 2%, 3%, 4% of the overall GDP to now. Excuse me. Let me change the scale here. We went from 6% of the overall GDP, the overall U.S. economy. Government spending made up 6% back here at the turn of the century. Well, now it's 40%. And so the increase here that I have is the percentage increase. If you look at it this way, government spending is also increasing rapidly. The size of government is increasing rapidly, and this also has a negative effect on growth. These two economists here, Berg and Henriksen, I will also link to this. But this is what that paper looks at, which is the size of government having a negative impact on growth rate. So not only the debt to GDP drag that we have, not only does it lead to eventually higher interest rates, which just makes the whole thing even worse. Not only that, but the size of government, as that becomes a larger share of the economy, that drags down your growth rate. And remember, the only thing that really matters is the growth rate of debt versus the growth rate of GDP. And what they find is that for every 10 percentage points, that's associated with a 0.5 to 1% lower annual growth rate. The debt to GDP, the prior study found about a 1% drag for every 10% above 90% debt to GDP. So you're getting dragged down in terms of growth on the debt to GDP level. You're also getting dragged down on your growth by the government getting to be a larger share of the overall economy. Here is debt to GDP in blue. And then here is this concept where, as if that wasn't bad enough, we started to introduce the concept of interest expense, right? And how radically that has started to increase so much faster than our economy has. Well, here's another way to think about that. So here up top, we have debt to GDP. And then in the bottom, you have the 10-year yield, right? So the cost of your debt minus subtracting nominal growth rate. So, if the cost of your debt is 5% or 6%, that's actually not the entire story. You need to look at what is the growth rate. Because if the cost of your debt, your interest rate on your debt is 5 or 6%, but your growth rate is 20%, again, that's actually positive. That's actually a positive return. You're growing so much faster than the cost of the debt. And so that's what this white line indicates. Anytime it's below zero, I have it shaded with a green box, and we can see that corresponds to decreases in debt to GDP. From kind of post-World War II era all the way up into the early 90s when debt to GDP bottomed, again, going back to that early 80s. Well, we had the cost of our debt was below the nominal growth rate, generally speaking. We can see debt to GDP declined. And the same thing is true, generally speaking, for this period of time in kind of the mid-90s, early 2000s. We can see debt to GDP slightly decrease, kind of went sideways because there was the dot-com bubble where it spiked higher. But the important thing here is this relationship, is the trend is starting to change. What we can see is that, we've had the cost of our debt below nominal growth for the past 4 or 5 years, but look at that is changing. We are right at zero. We are crossing over that 0% level. And I think, again, in the next slide we'll look at, I think that this is going to go positive. Remember, when this white line goes positive above zero, the cost of the debt is higher than the growth that you're getting in the overall economy. That is when the debt burden starts to really kind of get ahead of, really kind of weigh you down. So here's debt to GDP in white this time, and again, note the period of time where debt to GDP bottomed here. That was also the peak in the cost of the debt, ironically. So this correlation between interest rate and debt to GDP, this was also evaluated in the Reinhardt and Rogoff paper. But the point here is they focused on 90% debt to GDP, which would be about here on the white line. We crossed that in about 2010. That was their line in the sand. I'm not sure why they focused on 90% so much, but what I want to show is that the cost of our debt, interest rates were in a 50-year downtrend. Interest rates fell for 50 years. Well, when did they break out? They broke out in 2022, 2023. Well, look at what happened to the fiscal deficit, right? We're running this utterly insane 6%, 7% fiscal deficit that for the past 5 years, even though we're not in a recession or anything like that, a world war. I think the relationship here is starting to indicate that there is a level at which deficits do start to matter. There is a level at which debt to GDP does start to matter. It might not have been 90%, but look, interest rates have just broken out of a 50-year downtrend. If they continue higher, that has horribly negative consequences. Going back to the prior chart, if we cannot get our nominal growth rate above the cost of the debt, we are in for the debt to GDP will increase, which drags down growth, which probably leads to bigger deficits and more government spending trying to stimulate growth. Well, that just drags down actual GDP even more, right? So the whole thing spirals. And as that's happening, the cost of your debt is increasing because people are seeing you're in trouble. People are seeing you're heavily indebted and you have no way to repay them. So the whole thing can kind of feed on itself in a non-linear way. And I think that, they might have been incorrect to note 90%. It might have been 105%, as we have here marked. It might have been 110%. But there is a point at which debt and deficits do start to matter. There is a point at which interest rates will start to factor in the fiscal reality, that debt reality of the United States. There is a level. And I think that we are at that level now. I think that we passed it in the past couple years. I think that arguably the fiscal crisis has already started a couple years ago. So here, I've also thrown on wages in blue. And what I want to show, so we have yellow this is the interest expense for the US government, white is debt, and red is GDP, just like the prior charts. But here we have the average hourly wage in blue. And so post 1971, post the end of the gold standard, debt has increased 3.4 times as fast as GDP. And debt has increased 11.8 times as fast as wages have. Debt has increased 11.8 times as fast as the average hourly wage since the end of the gold standard. You talk about the restructuring of the U.S. economy. I think this chart, shows that to a large degree. Interest has increased 2.2 times as fast as GDP, and interest has grown 7.5 times as fast as wages since the end of the gold standard. So we can see that, the average hourly wage, which reflects the kind of average American and their health, we can see the delta between the debt and the interest and the average American. That average American is who is supposed to make up the economy, who is supposed to be one of the units in a large economy to produce value and to produce economic output and to produce GDP. But I will note that GDP has grown 3 times as fast, 4 times as fast as the average hourly wage since 1971. So the average American is not even keeping up with GDP. We established, hopefully, that GDP and economic growth is coming nowhere close to the debt growth or to the interest growth. Well, look at how bad the average American is lagging behind. You thought GDP to debt was bad. The red line to the white line, you thought that was bad. Look at the average American in blue. That gap is really indicative of a structural shift in the US economy. So here we have, finally, to end, the stock market and how much it has outpaced the average hourly wage. I had this chart in my prior video, but I think it's instructive and indicative of the structural shift that we see away from kind of an economy that benefits everyone, an economy by the people for the people, which we used to have for many, many decades. I mean, America built the whole concept of the middle class, the American dream in the 50s, right? And we had that for many decades. Our parents had that, our grandparents had that. Well, here, what we see in the past decade or two is that we've entered this hyper financialization. I think this chart shows that abundantly clear. I mean, after 2008, the stock market has outpaced wage growth by 400%. So we've turned our economy into this. We established that the government is just getting larger and larger and larger, right? And we know government spending is getting larger and larger and larger, and that has winners, of course. If you are a bureaucrat in Alexandria, Virginia, this benefits you, and you are benefiting from this thing. So there's always another side to the coin. I would argue 95% of Americans are suffering, but there are people that are benefiting, whether it's this or looking at the current account deficit, right? And the relationship with the debt. Remember, there are people that benefit from this. This is a $450 billion per quarter, so $150 billion per month bid into things like the S&P 500 and real estate and financial assets. So again, there are always a winner and a loser. I guess what I'm trying to illustrate here is that the average American has been by far losing out over many, at least 1 or 2 decades, if not 3 or 4. Here we can see, pre hyper financialization, you only had to work 10, 15, 20 hours at the average job in order to buy a share of the S&P 500. Well, now you have to work 197 hours of work, right? If you put it in those terms, hopefully it kind of really drives the point home. My parents' generation, they were able to invest and buy a share of the S&P 500 with 10, 15, 20 hours of work, right? 1 or 2 days, 2 or 3 days of work at the average job. Well, now you have to work 200 hours, which is 5 weeks. So you went from 2 or 3 days to now 5 weeks of work. This illustrates that the restructuring of the economy, this illustrates that is not the average American that is growing. We know debt has outpaced GDP, but GDP has outpaced the average American. And so hopefully, this was helpful in conceptualizing some of these things or visualizing them in a different way. I think that the cost of our debt relative to nominal growth will be really important to watch. Again, it's just starting to cross over. And I think debt and deficits are starting to matter. Maybe they didn't matter at 90% debt to GDP. Maybe that level should have been 105%. Deficit as a share of GDP at 7%. This has never been seen before outside of 2008 GFC and 2020 when the entire global economy came to a screeching halt. And yet somehow for the past 5 years, we've been running a 7% of GDP deficit. I think interest rates are starting to reflect the fiscal reality. Luke Groman says the bond market and interest rates are marking to market the fiscal health of the U.S. And I think that that's an accurate way to put it. So on that note, hopefully it was educational, and I will catch you on the next one.